The Kenya Bankers Association says commercial banks in the country are expected to adopt the annual percentage rate pricing mechanism from today, which is expected to usher in a new phase of transparency in the costing of products by lenders. The new mechanism will allow borrowers to easily compare lending rates among banks in what is expected to heat up competition in the banking sector, which has in the past been accused of operating a cartel-like industry.
If you look at the industry today, and that's a challenge, we was over $1 billion almost of bad loans. Now, I said in my earlier comment that none of you here is contributed to that. But everyone in the country is paying for it. Our NPL ratio in the industry is 5%. So we need to be able to go back into a lower rate.
The annual percentage rate will show the complete and true pricing of loans, taking into account the Kenya Bank's reference rate and other compulsory charges like legal fees, insurance cost, evaluation fees, and government levies in calculating borrowing rate.
The whole idea is that when the government comes into the market, into the domestic market and borrows domestically, effectively it creates pressure on the domestic market and the prices effectively then go up. Now, the government can avoid that by externalizing its debt so that it borrows from the external market, thereby easing pressure on the domestic market.
Kenya Bankers Association Chairman Joshua Oigara, however, says though the cost of credit in Kenya will certainly come down, the government needs to address challenges at the lands registry and improve security to reduce the cost of operations. Under the new model, banks will disclose the total cost associated with the loan, repayment schedule, and the APR, but the cost may vary every 6 months once the KBRR is reviewed by the Central Bank of Kenya.